How are you? Enzo DiCasanzo, clinical professor of economics and finance, St. Peter's University, Jersey City, New Jersey. It is May 21st, so we're a couple days past the start date for the online section for the summer, the first undergraduate summer session. I hope everybody's good. Obviously, obviously we've had a dramatic impact on the country with the virus situation. I hope you're all doing well. There's a few of you that I've worked with before, a couple of you a while ago, and so there's 2 or 3 people. I sent you some video to get you started a while ago. Now I realized not everybody was May 1st was registered on May 1st. I understand that, and for better or worse, that's just sort of what happened. But I sent you video early on, so the people, there's most people, there's like 2 or 3, we lost 2, got 2. We have pretty much the same number for May 1st, but we're 2 people left. 2 more people came in, type of a thing, which is a normal, typical thing that happens a lot with these courses. But yeah, so we're going to go. This is the first official video, and actually and I want to just say this up front. This is a video that'll be used for the fall, most likely also. So I'll be mentioning that, the fall this, the fall that, type of a thing. So, like I said, this for the summer people, I'm going to go through the chapters, and actually I'm going to go through the emails. I think is the best thing to do. So let's share the screen, and we'll just get to doing that. So. Okay. So yeah, so we have the screen going right now, and yeah, with Zoom, I would see myself sort of up in the corner. Here, you see it later, but that's fine. I know I'm there, right? I know I'm there pretty much. Okay, here let's do emails. Let's go to the emails. So here, folks, and yes, folks, we're gonna put everything on Blackboard, so please don't be concerned about that. But when you work, and I've worked in private equity for a number of years. I was at Rutgers for about 10 years before I came to St. Peter's. I've been at St. Peter's about 10 years. So I've been at this a while. I've been at this your lifetime and a little bit more. And you got to be able to work from an email. And email attachments and organize your emails. And here's one of the most important things that you need. I'm just going to click on this before I talk about the emails. You need a folder. And then, folks, this is your course right now. The syllabus is here. Here, let me just quickly open the syllabus just for sort of legal purposes. We went over the syllabus. Oh, and by the way, let's make sure that we're here. FN 401 WSU 1448024 Intro to Corporate Finance. That's the dates of the course. There's no exam, or no sit-down exam. It's all assignments, which is what you would do, if you did this professionally. So let me just make sure everybody's in the correct course. I use my NJIT email, and some people don't like that, I guess. I'm sorry. And I have all my emails in one place, kind of thing. And for some reason, even my other phone, the St. Peter's email doesn't come up. Certainly on my BlackBerry, it doesn't come very easy. I don't know why. I remember when I first attempted to download the Gmail when I first started St. Peter's almost 10 years ago. I was in the basement of the library, and for some reason, it just didn't want to download for whatever reason. Anyway, you have my number here. The course ID, it says the first day of the course, the last day of the course, and the exam. We're just going to have a bunch of assignments, and that's it. I'm sending you the textbooks. This is the finance book, but I'm using the accounting books. And again, don't worry about that. The material, it's finance material, but you can't separate the accounting rules and balance sheets and all that stuff from this job. Okay, so you really got to keep that in mind, that this is a finance course. It's not an accounting course. We're using accounting book because the examples are similar, and I like the accounting book where it's very focused and there's no it's clear. I think the accounting book is very scientifically written. The finance book, it's written sort of on the back of the envelope. There's things in there that I think could be explained better, and they're more math guys, the accounting guys that wrote the text that we're using. I sent you a PDF of that, and we're going to go through all the emails soon. So don't worry about the textbook and the syllabus. Don't worry about all that stuff. The email is going to have everything that you need. But here, agency relationship, financial statement analysis, we're going to do all of that in here. Risk and return, all those things. We're going to be going over that. Yeah, don't worry about these topics. I emailed you some topics. It's basically this. these three bolded ones is basically what we're going over. Don't worry about this. You're not, again, a few of you were in my live class. We have the tests and different things and assignments or whatever it might be. Don't worry about that. Don't worry about the cell phones in class. So yeah, when you go online, it throws a lot of this stuff sort of out the window. Don't worry about all these other type things. This is all just what it is. Don't worry about that. So I'm saying I'll post some Blackboard for sort of legal purposes. So yeah, this we don't need. Actually, this is the textbook file. So yeah, I don't have the textbook file in here, but I have it. Where do I have it? I have it here someplace. Here's accounting 10th edition. See, the textbook is here, the instructor manuals, my solution manuals, PowerPoints, some of the test. And this is for more the sit-down class, the Excel, my master Excel file. It's about 3 megabytes, so 3.5 megabytes. It's a pretty big file. This is the basic accounting equation. So if you guys forgot, again, this is all in the textbook. Okay, what's an asset, liability, owner's capital? This is all in chapter 2 in the textbook. So you want to go to chapter 2 in the textbook. You know, what's a plus, what's a minus? Like I said, so you want to read through chapter 2 just for purposes of just getting your the debit credit rules and things like that. Certainly feel free to do it. But again, notice I have a folder for everything, and very organized. So folks, we like Blackboard, and there's certainly advantages to using it, but you got to be able to organize your emails and organize your attachments, and you got to be able to work like that. So what I did was, and maybe I should say this more in class. I mean, I like to think you guys are savvy technically, but maybe just for whatever reason, maybe there's a couple things maybe you could use to hear. Again, I typed in my email and FN401 in the search bar, and I came with all the emails that I sent this section starting on May 1st. Forget about all this other stuff. May 1st. Okay. So, but yeah. Okay, that's where this starts. So 1, 2, 3, 4, 5, 6, 7, 8, 9, whatever, 10, maybe 10 emails, 10, 12 emails that I've sent out already before the course really started. This is the initial YouTube, so let's just click on this initial email. And this talks, again, let's just review what I mentioned to you guys on May 1st. Maybe not everybody got this, but I forwarded them. As people added, I forwarded these emails to people. I can resend all of them, but this particular course is going to deal with long-term debt, investments, cash flow analysis, financial statement analysis. I don't know if we're going to get these. Actually, this first chapter is very thick. It's a very hefty chapter. There's a lot in it, and that's a double chapter. Okay, there's significant amortization models and tables, and we'll be going step by step through everything. I got an email from somebody saying, "Oh, well, the self-test is just some questions, but there might be some computation involved. That's why we do it in Excel." And I'm going to explain that to you guys, how that all sort of works. And actually, here, and what I'm going to do? There's 4 assignments so far that I sent out. I'm going to click on the Excel. Here it is. Yeah, and again, long-term liabilities is in there. Assignment number 2. If people were asking about assignment number 2 and why, and all the, again, the reason I made a template, pardon me for that noise. The reason I made a template for assignment number 2 is I wanted you to just, you could have worked in my template, and there's some computations you have to be made. So I sort of set you up to work out some of the problems. A few of the problems, there's a little bit of math involved. That's why. So I got an email to that effect. They asked me why that I sent you guys a template, but that's why, because there's some mathematics involved. Okay, in the videos, and folks, you have to, there's other tabs at the bottom here. These are the chapter notes. This is significant. Okay, this is significant. I'm not saying that we're going to cover one chapter, but believe me, if you came to this course and this is the only chapter we did, you'd have learned a lot. Okay, so don't be concerned. Oh, don't get hung up on the chapter. There's people who are like that, but don't get hung up on that. Okay, because that's not helping you. You have to be able to logically think through things. So you can see accounting for bond issues, accounting for bond retirements, long-term liabilities, statement presentation and analysis, comprehensive problems. There's 3 appendices, or appendices, whatever it is. There's and here's the self-test questions again, which I am going to go over these. I am going to go over the self just to get you guys ready. And I didn't make the template for assignment number 4, which is the self-test questions for the investment chapter, which is the next chapter. Okay, I didn't make that, but I will. I'll make that template. And again, this is for the fall. Again, if we use these videos again in the fall, all that applies to the full also. Why bonds are issued, entries for the issuance of bonds, describe the entries when the bonds are redeemed or converted, describe the accounting for long-term notes payable, contrast the accounting for operating and capital leases, and identify the methods for presentation and analysis of long-term liabilities. Also, folks, I just wanted to mention this. I know the course started Tuesday, but again, I email all of you guys, very, very early, in the course. Let's get back to the emails. Yeah, this is 12:30 in the morning on May 1st. So I emailed you 21 days ago to get the majority of you. And again, if people came in later, there's no penalty for that. You're not losing, but just hey, some people you registered early and you had a little bit of a extra sort of a head start. But don't worry, people who've taken me before certainly have an advantage also. And there's a couple of you out there that have worked with me in the past in different capacities. So anyway, these are the topics, and these are all the text. It's going to be in the textbook right here. You should download this textbook, to your, here's content right here, or here's brief content. You should download this to your folder. Okay, so you're not just constantly finding that email. You should work from a folder. Like I don't work from emails, I work from the folders, and I download what I need. I just want to give you a reason why I like to work with the emails. Like I said, we will post everything in the Blackboard, so don't worry. But this textbook is substantial. This is 26 chapters, and it could take, if you to really work through this, it could take you a couple of years to work through this textbook. We've covered corporate transactions and dividends, and we've done a lot of this stuff. It would have been nice if we'd maybe covered current liabilities, in chapter 11. We didn't do that, but that would have been nice to sort of, that we could have maybe worked that out a little bit. We'll see. Not the payroll, because payroll is more managerial, but the current liabilities topic. I spent a lot of time on partnerships, but what we're covering is right here: long-term investment statement, cash flows, and financial statement analysis. Now, again, there's no guarantee that we're going to get through everything, but you have this textbook. You can take it with you. Don't delete it after the course is over. That's another thing with Blackboard. Once the course is over, I don't know if you still have access to Blackboard. So, I want you to download everything. I did send this out in an email. We'll go through the dates. I sent all the emails out in a little bit. Okay. Actually, back to this. So yeah, so here's the topics. There'll be YouTube videos, which the first one is now. And what I'm going to do, see, in the emails, and I'll tell you how I'm going to set it up. You're going to have a couple videos per chapter. I'm not going to just, I could sit here for 8 hours, I suppose, but, there's going to be a PowerPoints video and then a couple of Excel videos, and I'm going to talk about the assignments a little bit. And this will be, you'll get the same email, but just with, more links added as you go. Okay, so you're going to, and then I'm going to add the minutes and the hours and how long the videos are and that type of thing. And here's, again, just making sure that we're all here with this. If everybody's name pops up on the screen, I apologize. I don't mean to put people's emails and stuff up on the screen like that. That was just a little slip of the mouse. So by the way, my mouse, this computer I have is about 10 years old. This September will be about 10 years old. There was a little, I guess, dust in the little roll wheel, and it wasn't working as well. But then somehow when it warmed up, it sort of started working again. So yeah, so the mouse can last a long time. I'm more of a keyboard guy, but we use the mouse a little bit. Anyway, YouTube links. Now I sent you. I think this is about 8 hours of video. It says 8 hours, and I sent this to you May 1st. So I wanted you to at least watch these. One or two. One a day maybe for a couple days or whatever. You could have done 2 or 3 a week or something, and just to get some idea as to pension plan videos and capital appreciation. This is all very good corporate finance material. You should watch all this stuff. You're given all these emails and these video links: time value of money, inflation, interest rates, 30-year cash flow. These are substantial videos. Okay, so hopefully, and again, if you took a course with me in the past, you may have seen some of these. Pardon me, folks. One second. You may have seen some of these before, which is fine. Okay, there's nothing wrong with reviewing, but you were sent a lot of videos early on. Now, for the people who just sort of got in the course recently, take some time and watch these. But the video for the homework is going to be tonight, and we're going to talk about the PowerPoints. Okay, so you were sent this May 1st. Okay, so let's just sort of check that off that we discussed that. Forget about this. The textbook I sent you on May 3rd. I sent you the textbook chapter or the textbook attachment and how to read it. And again, I think I forwarded this to people, and if I didn't, I certainly. I like to think that everybody had this. If you don't have the textbook attachment, but again, if you took courses with me before, I may have sent this. This is just the same file from a couple of years ago. So if you worked with me before, you probably have this already. So look, even if you didn't have it on your hard drive, but look at your old emails, and it's going to be in there. And it says what chapters to read. And again, we sent this out May 3rd. Okay, so we sent this out a while ago. Textbook, did the syllabus thing. Yeah, like I said, we looked at the syllabus, which is fine. I'll send it to you if you want it, but go with the emails, textbook. Yeah, can everyone respond? I sent an email out. Can everyone please respond? So everybody's getting the emails. This was on the 5th. So again, I staggered it a little bit just to get people sort of working. Again, if your name or email pops up, that's not on purpose. Yeah, now some of the rest of the emails were just simply the assignments. Okay, so we're up to 4 assignments. Now what I'll do, again, until we get Blackboard up and running, there's 4 assignments right here. 2 of them are definitions. You just read the definitions from the textbook, and then 2 of them are self-tests. And then we'll have a couple more assignments. That's all it is. Okay, and actually a few people even sent it to me. I want to set up Blackboard because I may be doing some very large magnitude online teaching for the year coming up. We want to set up on Blackboard where we can just deposit on the folder. But again, just give me a couple days, to work on that. Okay, like I said, folks, I'm Italian, and I grew up in Newark, and my father planted tomatoes and figs and all these berries and grapes. He planted all these things, and anytime you're growing something, you gotta have some good dirt, put the fertilizer in, put the seeds in, cover it with more fertilizer, water it. The sun's got to hit it. That's growing something. So when you work on these courses, I didn't want to just come to you like a machine gun on day one. Since we've already pretty much had a little bit of interaction by email, I don't want to just come on the first day and say, here's 5 more videos for you guys to watch. So, I wanted you to sort of slowly get cycled up. It's like the baseball spring training. You guys hear the baseball's going to start again in July, but they got to play for 3 weeks and exercise so they don't start pulling muscles. And especially as you get older, like me, you got to get in, I'm not 17 anymore. When I ride my bike extensively. I got to, rub the back of my legs and the calves, and I generally don't pull anything. But you want to get and that cardio workout is good because the muscles get sort of massaged into shape, and you want that. So like I said, same thing with you guys in the course. I wanted to sort of ferment a little bit, and hopefully these ideas have been fermenting for 3 weeks, and now we have another whatever till the end of June. We're going to continue to work. So you have the majority of your assignments right now, but we're going to do a few more. And we'll do a lot. So we'll do a video today, video tomorrow, video Saturday, video Sunday. So I promise you guys about 4 days of videos in a row. And usually the PowerPoints are about 40 slides, and it takes about an hour. But there's 80 slides with this, and so we may go a little bit longer. I'm not going to do any Excel tonight, just to get you guys sort of in the mode of things. But we'll be doing some Excel after the PowerPoints. All the other videos are sort of Excel videos. Now I want to say something that happens in the semester, which I don't like. People know, generally I have a lot of repeats in my courses, and especially in the spring. It's a lot of people who work in the fall, they come back again for the spring. The majority, I have 70–80% of my students in the spring are on their at least second course, maybe more, which hopefully I think is a good thing. You can't avoid the PowerPoints, and notoriously people avoid them because, okay, we don't talk about Excel and just give me the homework. You can't just run to the homework. Okay, school is meant to operate. You being in school, you should be operating the following manner. You hear the PowerPoints, you read the textbook chapter, maybe you do some stuff online, you search around in some articles about what we talk about and debt instruments and different things and spur your interest. Then you try some of the Excel models. It's a process. It's like planting something, right? It's a process. It's got to be step 1, step 2, step 3, type of a thing that we have to look at. So just sort of keep that sort of thinking in mind that, you have to be able to work sort of step by step, through everything. And it's just running to the homework is like the 4th thing. Okay, PowerPoints, read the chapter, work the problems that I work out in class and learn from those, and then apply those to the homework. What happens so often is people just run to the homework, get frustrated, and this and that about the course, So you got to work it in steps. There's no shortcutting it. You don't want to be somebody, and especially the legal world. And folks, again, in addition to my engineering background and finance and accounting background, I have a paralegal certificate from CUNY also. And the reason I got that is we live in a world where you're always going to need lawyers for things and regulations, and especially in financial services, you're not going to survive. And even if you're for the government or law enforcement, or the prosecutor's office or something, you're going to be buried in court cases and what happened and this and that and the precedents and how the government works and who makes the laws and who does what. You have to understand all the pieces to the puzzle. So that's what we're teaching. We're teaching you to work very methodically, logically, and I just want to mention, and this has really nothing to do with anybody in this class, but I just want to mention what happened in the spring that really bothered me. You know, people, you know, I've said to people, you know, don't use package. Now we did statistics, so in the spring, so that's not going to be so readily available to you guys, but to do this, but you know, you have to go step by step and building block by building block through everything. The point of the statistics courses that I taught, the material that I taught, and this thing was not that you got the, you know, the predictive equation answer from software. The point was that you could build the model, all the cells, the x coordinates, the y coordinates, you know, operate on them mathematically, derive the equation, you know, make some predictions with it or some forecasting with it, to go through all those steps yourself, not to just run to some packaged software program and, okay, well, I entered the data and did it for me. You know, that's not what I'm teaching. Okay, you can do time value of money, you can do all that stuff in Excel. There's actual functions, but I'm teaching you at the nuts and bolts level, and we're doing that on purpose so you can be custom mathematical model builders. That's what no matter what I'm teaching, that's what I'm teaching. Okay, Rutgers here, whatever it might be. You know, that's that's what I teach and what I do is that type of thing. It's how to build a model and all, including, you know, from the ground up at the atomic level, building all the pieces. And again, I think is what we do as kids sort of just brings us to, you know, what we do as kids just sort of brings us to our future here. You know, I was on the floor in my living room in Newark, growing up in my family's house, building blocks, Lego, watching Star Trek, you know, trying to take the TV apart a couple times and didn't electrocute myself. I was that, so I get, you know, my father's a car mechanic. I was always building things. So I just, you know, as a job and a career, it spoke to me to do something where I can construct something. Watching my dad owned a auto mechanic shop on Bluefield Avenue in Newark, God rest his soul. And, you know, and as a kid, watching him going and just being dazzled by him, how much he knew about everything. I would go over there, and I think I learned very early, just learning from my father, that, you know, it's important to be good at what you do, you know, and to take pride in it, be honest, and all those things. You know, you can't. I sent an email out, a rather scolding email in the spring, and I told folks, you have one reputation. Once your reputation's toasted, it's tough sledding going forward. You know, it's tough sledding going forward. You know, that's you want to be good at what you do. You want to be trusted. You want to be honest and say your opinion. You know, what you're forecasting for labor numbers, or what you're forecasting for the economy, or inflation, or whatever prices, or whatever it might be. It is what it is, and you got to defend it with reasons. You know, and almost like you're in a courtroom. Okay, so we want you to work like that. And like I said, I've had a lot of success at this. You know, people online have done very well. So, you know, don't worry. Oh, you know, how are things going to go in this class? Don't worry about that. But like I said, you know, I'll resend the email tonight with all the assignments, you know, all reattached and the Excel template. And like I said, with the Excel template, you should copy and paste this into your own Excel. So as I'm writing everything on here, you should copy and paste into your Excel, and you should be nimble enough to be able to do that. Yeah, and you got it. And now I know some of the, I saw some of the homeworks were handwritten. So I got a couple of handwritten homeworks today. And, you know, obviously I want you to be able to do this on the computer. So I don't know what happened with that. I know schools shut down, and, you know, obviously I can't be but, you know, the course is meant to be electronic. It's meant to be, you know, using your computer. It's meant to be using the Microsoft Office suite. I know we live in a time right now where I might have to accept some sort of handwritten stuff, and you can, I suppose, but I'm not, you know, I'd rather you work everything out on computer, or use cousins or family members or something like that. But just know that. And like I said, so as you're looking at this, and someone also emailing about, you know, why am I sending the Excel files out? We're going to see all these gray cells. We're going to go through all the math, and we're going to go through bond basics and accounting for bond issues, and, you know, we're going to go through all this stuff. Okay, the PowerPoints just to put the ideas in your head and the vocabulary sort of out there. But we're going to go back, you know, tomorrow and the next day, and I'm going to work out all these problems. You can see there's some significant problems here. Okay, and we're going to work, well, especially in the appendix, where it really gets technical, and it really gets, you know, math modeling is involved. The comprehensive problems are kind of long, and there's a lot of entries, but this is all mortgage payments. This is all finance, folks. Don't think that it's not, okay, just because the book says accounting. So I hope nobody's running around saying, oh, it's an accounting book, whatever. You know, I hope not. You know, it's finance, folks. Believe me, the accountants are the ones who control it. Don't ever think that's not true. It definitely is. The scientists work for the accountants. That's generally the CFO of all the banks and those folks, they're all CPAs and all that stuff, because you got to know the rules, and you got to know legally, what's going on with what you're doing. Okay, I hope that I introduced the course relatively strongly and clearly, and like I said, just be able to click on the different. Now, I like to control page up, control page down. That lets me move through it without messing with the mouse and the little roller wheel and all these other things. What I would like you to have done on your computer in terms of doing this homework is just highlight the answers, and then you can just send this file back to me. And what I'd like you to do is I'd like you to make a file with your name and the course, and labeled as the see, look at this. It says Excel file summer 2020 FN 401. Smartly name your files, and your name should be in everything. Like, see at the top here, your name, the date, the section number. That was another problem that we had in the spring. I was getting things from people. Now, there were reasons for it that weren't so legitimate, but I was getting files from people where there was no name in the file at all, and that's most likely a copied or a friend sent to them and they deleted the page with the name on it or something. That's very bad. Okay, and it happens, and I warn people to not do that, and they did it anyway. And that's no good. And to carry those kinds of values in life is no good. Okay, we don't want you to work like that. Okay, be honest in what you do. My father always told me that. Be very honest in what you do. So, okay, yeah, let's get to the PowerPoints, which is what we're here for. Okay, so so sermon is over for now. Say F5 to make it as big as the screen, hopefully. And we'll see. I should be in the little corner, but we'll see what happens. If I disappeared right now, that wasn't on purpose. Okay, long-term liabilities, why bonds are issued, entries for the issuance of bonds, interest expense, entries when the bonds are redeemed or converted, describing the accounting for long-term notes, contrast the accounting for operating capital leases, and the message presentation and analysis of long-term liabilities. Okay, 1, 2, 5 basics: issuances, retirements, long-term liabilities, statement presentation, and then all the details: the types of bonds, market value, issuing procedures, face value, discount, premiums, right? Redeeming bonds at maturity, before maturity, converting bonds into stock, long-term notes payable, leases, the presentation, the analysis, some of the ratio analysis. Okay, this is all good. This is folks, I worked in private equity for a number of years, and again, the people who've taken me for sort of know my story a little bit. I worked for a training firm in New York that did Excel training. That's why I use a lot of Excel all the time. And I'm telling you things that are very important to deal mechanics. And refinancing, the refinance for an African nation a couple years ago. I've worked on and off with some of these guys. Now I'm sort of on my own, and I'm sort of happy to do that, because I just didn't, sure, money this, money that, but I didn't like some of the transactions we were doing. And I'd rather just be a little more. I'd rather just be a little more technical in terms of what we're doing. I don't know what that was, but so. Yeah, so anyway, so advantages. Now, bonds are a form of interest-bearing note payable. It's a loan. Now, the difference between a loan and a bond is a loan comes from a bank. You go to a bank, you borrow, $250,000. That's a loan payable or mortgage payable. A bond there's slivers of ownership, or there's slivers of lenders where it could be a bank, it could be an individual, it could be Michael Dell, it could be Mark Cuban. It could be whoever, it could be banks plus very wealthy individuals loaning, Amazon, $1 billion. And everybody loaned them, 10 million or 100 million or something like that. It's something that's done in pieces. And then it's an instrument, and that instrument's traded. Okay. And really what a bond is, it can work in two different ways. You could have a bunch of cash flows, 20, equally spaced evenly every year. Some money's paid back, some principal, some interest, and then 20 years later you're done. Or a bond can be, there's interest payments, and then there's a bigger payment at the end, sort of you're paying back the principal, and you pay back all the interest pieces, over time. So those are a couple different ways that all sort of happens. And you want to compare, when any venture that happens needs capital. That capital comes in one of two ways. Somebody invests, or there's an equity owner where, if there's a hot dog truck in Newark and the guy needs 150,000, believe me, those operations, hot dog trucks and those kinds of things, they can cook. You get a good mobile kitchen, you're talking 75,000 and up easily. Remember the Jamaican truck in front of the school a couple years ago, and there were some different ones that were sort of Jersey City, a little more than Newark, but Jersey City sort of has them. A little, upper crust version of the lunch trucks. Rutgers Newark, there's a Mexican one at Rutgers Newark, and actually, it's so crazy. Where I live in the North Ward, I saw that truck parked a couple streets over from where I live. I didn't go up to them and say, "Hey, are you the guys from Rutgers?" But I think it is. I think it's like a taco truck or something. But any business that happens needs capital. Now, if it's a loan, the business accepts the loan, buys its equipment, pays people, runs its business, makes a profit, pays the loan back, and all the money after they're financing the debt, maintaining the debt is their money type thing. Okay, so that's when you get a loan, that's how it works. Where as long as you pay it back, all the earnings from the business are yours. When it's an equity owner, that person makes a deal with you. Say, okay, we'll come with the capital, we'll keep 90% of it, and you'll have 10% of it, but the business is basically theirs. It's who comes with the money. Is when I was now, or they could say you have rights to any of the earnings, and we're just going to pay you salary. That happens too. Okay, so that's how businesses work. Now, a bond is a flavor of financing where you're comparing if it's an equity investment, a debt investment. There's tax. If you've got debt payments, there's generally a tax advantage for a couple different ways. There's a tax advantage just straight in the sense where your earnings are impacted by having this extra bill you got to pay in terms of your interest expenses. Just naturally, it's reduced. Your earnings are reduced, or there could be a deal with the government where the local government says, okay, if you come build housing in Belleville, New Jersey, you don't have to pay taxes, property taxes for a couple of years or something like that. So there's a couple different ways that those can be that can happen. So, but you want to analyze the earnings from an equity investment, analyze the earnings from a debt investment, or some combination, which is generally what happens in private equity. It's usually a combination of things. Like I said, there's about 80 of these slides, so we have a long way to go with this. This little now I'm going to say this, in class. This model that you're seeing in front of you right now, see which is income before interest and taxes. This is chapter 15, so they're sort of assuming that you got through all the other chapters. I'm not making that assumption. I'll teach you everything just sort of as you need to know. Don't worry about, it's chapter 15. Does he expect you to know everything? Don't worry about anything like that. But income, it's just what it sounds like. Income before interest and taxes is what it sounds like. So this business, whatever it might be, you could have a hot dog truck that brings in $1 million a year, or a pizza place or something. You can have something like that. Now, I know an ex-girlfriend of mine, her family lived near a pizzeria, and people in her family, I guess, knew the guys running it or something. And she told me that they brought in $20,000, $30,000 a day. Now, I don't know if that's revenue or I think that's just money that comes in the door is really what I think it is. But, you could have a pizzeria in Elizabeth, New Jersey that brings in $20,000, a day. That's or $10,000 or $12,000. I forget what the number, but it could have been something. You get enough people. I mean, I cook all the time is the sort of the classic Essex County Italian, but the more Americano, right? They like to order out and get something. You feeding a family, very easily you could be hitting $100, $150, just for an order for 3 or 4 people. I remember the dinners we used to have in New York, and they were excessive, but they were easily $1,000, $2,000 for 5 or 6 or 7 people. It was a whole event, and there'd be a meat course and dessert, and there'd be entertainment, and they would really go. Oh, I sort of missed that, but not really. I got it. Believe it or not, that might sound interesting, but the St. Regis and the Peninsula and all these different hotels we used to go to all the time, it can get a little bit boring, if just the business wasn't going very well, but somehow the entertainment never stopped. That was a problem. Anyway. But getting back to this, though, any kind of business, and it throws off $1.5 million, that type of thing. Now, if you've issued bonds, if you've got interest payments, you got to cover that, and that could be substantial. If you look at this, that's about a quarter of the interest before interest and taxes. That 400,000 or 1.5 million, it's like 400,000 or 1.6. That's a quarter of it. So your income before taxes is a lot higher when you don't have debt payments as opposed to when you are servicing debt. Just from this, you're going to have lower earnings because your tax expense, the 30%, is from a smaller number. When it's 30% of a smaller number, you're going to have less income tax expense. Now, the forces at work here where this is a bigger number, you're taking out 30%, type of thing. How is that all going to filter down to net income? You have a lower tax expense when you have bonds, but you're also not earning as much because there's a big piece of the money that comes in the door that you got to pay out in paying the debt off. Okay, so that whatever this is, that $300,000 difference is for that reason, that you're servicing the debt. So believe me, if you can be debt free, that's generally better. Okay, don't worry about the tax advantage or whatever it might be. Just to pay low taxes, you're going to go into debt. that may not be the soundest philosophy. Also, I don't know why the book does this, but I guess if the financing was here because of debt financing, there's less shareholders out there. Because if you're you loan money to a company, now you might not have any shares issued. I mean, you can, but there may not be any shares issued. I mean, it can convert to common stock at some point, but there may not be any shares issued for there may not be any shares issued for that you making that loan. So if you look here, it's stock only financing is 300,000. Excuse me. Stock only is 300,000. That's orange juice, by the way, if you're wondering what that is. And we have the debt financing. There's only 100,000 shareholders. So I mean, if both sides had 300,000, this EPS would be lower, because it'd be 300,000 divided 7. It would be $2 or something like that. This is 350 per share. So the per share number is net income divided by shares outstanding. Net income divided by shares outstanding. And again, in Excel, we're going to go through. I rambled through this very quickly, but in Excel, we're going to go over this again. Okay, so just keep that in mind. So I don't expect you to be perfect at this in 5 minutes. A disadvantage resulting from the use of bonds. Let's see how good I am at answering these questions. Yeah, it talks about the principal and interest of the. Yeah, the big disadvantage is probably that last one, right? So, that's not true. Okay, they're not. They're not tax deductible principal and interest, but you have lower earnings and you have to pay less taxes because of that. But there can be a deal with a municipal, like New York City might say, hey, Amazon, come build your warehouse, we'll give you a tax break, until the politicians sunk that deal for the people of Queens, unfortunately, right? So anyway, the principal tax is principal and interest. Principal is what you borrowed. Interest is what's paid, for the life of the instrument. It says the principal tax is deductible, and interest must be paid. No, principal is not tax deductible. So that's not true. Interest is not tax deductible, and principal must be repaid. Again, it says interest is not tax, but again, you pay less interest. I mean, you pay less taxes because you are paying interest. It's not necessarily. I mean, it can be though. It can be. This book is not to that level where they have tax deductible interest, but it's got to be the last one, right? So interest must be paid, and then principal must be repaid. So yeah, that's going to be D. Is what that one is. Okay, so you have to pay the interest. That's a disadvantage of the bonds, where it eats into your earnings. Now, again, I've taught this course. This is probably the 12th time I've taught the 401 course at St. Peter's. So I have all these models in my head, and I change what I do all the time. So you see those videos that you guys just saw, on May 1st, that was those are videos from a couple of years ago, and I had them around, and I just sort of resent them to you guys, so you could just sort of jump in the water a little bit and get sort of loosened up with this. But it's a process, and it needs time, it needs fermenting, it needs you're thinking about it. And look, I'm not saying you should be like me and work like me, but I'm the kind of a person where even when I was in Queens, I did my legal my law school stuff a couple years ago, and I was on the subway in the number 7 train thinking about the what we did in class. I'm that way, and so hopefully you guys with this, the more you can walk around and think about it, I think the better off that's going to help you to work like that and to think that way is going to do better for you, where you're constantly thinking about this, and then the pieces start to fall into place. Folks, let me tell you, sure, everyone wants a job and go to work in New York and wants to make a lot of money, all these, but if you're very good at what you do, things will work for you. Things are going to work for you if you're very good at what you do. Now, these are some types of bonds: secured, unsecured, time and serial, registered bearer, convertible, callable. We're going to go through, and again, you guys probably know these maybe a little bit better than me because you just worked on the definitions of these. There are definitions in the back of the text. We can actually, let's see, do we go through these? Yeah, we didn't go through the definitions of this, but and that's a comment that I've had over the years. People say, I wish you would go over the definitions a little bit more. So, yeah. Now, I hope what you didn't do is just run to the end of the book and just copy these definitions out. I hope that you've read through the chapter and the glossary and all those other kinds of things and sort of got a little background. But this is the textbook. So what are we looking at here? We're looking at secured, unsecured. A secured bond has specific assets the issuer pledged, so that could be a house. Unsecured it's just the general credit of the borrower is also called a debenture bond. So this, it's unsecured debentures. Just your reputation, you being Michael Dell, or you being Jim Dolan, or you being, the Steinbrenner family, or you being, even Donald Trump, or something like that. You being, and believe me, Trump, they swooped in at the end of the financial crisis, bought a lot of property, in a lot of distressed property, and built a lot of. I think he owns like 17 or 20 golf courses or something like that. And a lot of those were so that's late in his. He was like 60 years old 10 years ago. So, he had lost money on the football team and lost money on this and lost money on that. And but he, if you stick with it, the right time for, when property prices are very low, you'll swoop in and be ready, especially if you have cash on the sidelines to do things. Term and serial bonds, single specified feature, a future date. So just once, bonds that mature in installments. So it can be pieces of it that you have to pay as you go along. Registered and bearer bonds, registered, issued under the name of the owner, and the bearer bonds are not registered. It's whoever bears them or has them in their hands. You guys remember the movie Heat from Al Pacino and De Niro in the mid 1990s? The movie Heat, where they robbed the banks and they were stealing bearer bonds. Remember what was his name? Tom Sizemore, I think it was, or something like that. That was they blew up the armored truck and all that stuff. So that's what they were after. Whoever has in their hand, that's the owner. That's a bearer bond. Convertible and callable. They're subject to retirement prior to maturity. The option of the issuer that was callable, and the convertible ones were put the bondholders convert them into common stock at the bondholders option. Okay, but like I said, the people who are working on the definitions, you knew those probably better than I knew. Issuing procedures, again, the law plays a big role in this work as you go along. Laws grant corporations the power to issue bonds. Boards of directors, stockholders must approve the bond issues. Boards of directors must stipulate the number of bonds to be authorized, the face value, the contract. And again, these are very political. Board of directors and political groups, and the council for your town where you live, for Belmar, New Jersey, or whatever it might be. These are very political groups, and they may not be the most math-oriented people. And your value in the deals is you could be the guy that explains the math. I think that's a good role for myself and for so many of you. Bond is a bond indenture. Paper certificate is $1,000 face. Usually bonds are usually in $1,000 face values or $1,000 pieces. It's a promise to pay a sum of money at a designated maturity date, and then a bunch of periodic or contractual stated interest on the maturity amount. And again, when I say these words in my head, I'm seeing all the math, the interest payments, and it's usually semi-annual. I apologize for scratching my nose. Sorry. Generally issued when the amount of capital needed is too large for one lender to supply. Folks, 1 second. I apologize, folks. Sorry about that. Okay. But yeah, so that's what's happening with this. Some of the money at designated maturity date, plus period interest at a contractual stated rate on the maturity amount. Interest payments usually made semi-annually, generally issued when the amount of capital needed is too large for one lender to supply. Okay. So yeah, maturity date, period interest at a contractual stated rate, usually made semi-annually. Yeah. Okay, that's everything that you need. Okay, that's everything that you need. So. Okay, so you have all those. Yeah, you're not going to see these too much. Who issued the bond? Now, again, this is a company saying, hey, we want to raise capital. We want to raise $5,000. We're going to pay this amount of interest. When is the interest going to be, or when, when's the principal going to be due, and the face value, the par of the face value of the bond, the contractual interest rate, the maturity date. There's not physical certificates any longer, but it's certainly at one time there were. Market, yeah. Now look, these instruments, there's cash flow. Anything there's a cash flow, you can buy and sell. Okay, when you're buying shares of stocks, what you're doing is you're saying, okay, I want my dividend for, the stock that I own, type thing. If I own Johnson & Johnson stock, I'm buying that dividend, and I'm going to pay a certain price to receive that dividend, or buy shares of Amazon or shares of Apple or something, like that. So with a bond, see, now with a stock, you're buying shares of the earnings. With a bond, you're buying specific interest payments, and it's not so easy for just the everyday person to start buying bonds. You have to do it through a broker, you have to do it through Bank of America, you have to do it through something like that. And it's not as obvious because it's not quoted on the television. It's the stock stuff is quoted, but the bonds are a little more secretive. So, but there's a market rate where, as the price moves up and down, now it's certainly not going to be the face value, but the prices of these bonds moving up, and the reason it's not going to be the face value is you have all the interest payments that add to the value. So if it's 10 years of interest payments and a principal at the end, that's 11 cash flows basically, or 10 if you combine the last one, type thing. And you're going to say, okay, I want a return of 5%. What am I? And there's math involved to do that. I'll show you that math. If I want to make 5% a year, what am I going to pay for that? Okay, that's market rate. So that has nothing to do with the contractual rate on the bonds. Tells you what the annual or the semi-annual interest payments are, and that's it as a percentage of the principal. Okay, the market rate is your return that you're doing. Now, if you could just buy a financial product from Bank of America and it gives you 10%, why are you going to worry about bonds that give you 5, 6, or 7 when you can just make 10 and forget about it? Okay, so that's what that really means. Callable, convertible. Yeah, there's a couple rates. It's a bar. I'll say the market rate is not this. That is, I mean, it can be. I mean, lightning can strike. It could be that number, but it's generally not going to be that. And now, if you do that, you're going to buy it at face value under certain conditions. Okay, but like I said, we're going to go through the valuation mathematics. And again, I'm putting the ideas in your head. Is what I'm doing. Like, I'm putting all these ideas in your head right now. But we're going to talk about them some more. And like I said, we're not going to just blow through this chapter. Because we can do 10 chapters in 6 weeks. We're not going to work like that. We're going to spend a lot of time in this chapter. We'll probably do the investment chapter, and then we'll say. But like I said, you're doing substantial modeling in this long-term liability chapter, like 2 chapters. Okay, so there's a lot of detail that's involved in this, and that's what I'm here to teach you. I'm here to teach you. That it's not just some quick and easy little thing. It's not just a bunch of multiple choice questions or, sure, your initial assignments I think were relatively straightforward, but I'm going to show you how to model, and you're going to learn that from tomorrow's video and Saturday's video and Sunday's video. How to do all that, and you could, there's no rule that says you can watch these videos once and that's it. You can rewatch the videos a little bit if you want. Okay, so just keep that in mind. Corporation records bond transaction like sells, retires, or when the bondholders convert into. It doesn't record transactions every time interest is paid in the sense where as long as the holder of these instruments, the corporation don't even care who holds. I mean, they do, but that's not that. There's no bond transaction when ownership changes place or changes hands of the instrument. So of investors. So so that's it says right here. It's never journalized when those instruments change, and now it's journalized and ledgers and stuff for when the owners, if person A and person B. If person B buys the bond from person A, there's journal transactions there, which we'll talk about in chapter 16. But Johnson & Johnson, they don't. Nothing happens when the shares of their company change hands or the ownership of the bonds change hands. They don't make any journal entries for that. Yeah, folks, I apologize for this. This should be face value. I think this is going to be premium. This is going to be a discount type thing. So you're buying all the cash flows and the principal payment. So when it's 10%, you're at face value. When it's 8%, you're buying it at a premium, right? Because you're paying a lot. You're paying more than face value at 8%, meaning that your return's only 8%. So you're paying a little bit more than the contractual rate, and you're paying less to get 12%. You're paying less than the face value, which means that bond is not. And money speaks to the demand of instruments and houses and cars and hamburgers and all that. Ground meat, all those chicken, boxes of chicken, all those other things. So if looking at this, if you're paying a smaller amount to get into an instrument, you're going to have a bigger return because these are fixed cash flows. The reason that the price of bonds go down and the returns go up is because people feel like there's better opportunities in the equity market. So as there's less demand for fixed income, you're going to have a bigger return on the bond because you're paying a lower price for it. When you pay a lower price, you get a better return. When you pay a high price, that return shrinks a little bit, and that certainly impacts how the Treasury lends money and all these other kinds of things. Yeah, folks, it should say it in here, face value and whatever it might be, discount, premium, all that, but it doesn't say. I don't know why. Yeah, so they're I don't know why they're gone. It's and this is in the tax. You look at the tax rate. It's just illustration 15.4. Let's find it. Yeah, there it is. Premium. So all the pictures are just in the tax book. Okay? It's like I said, so reading the tax book, and again, you got to go through the steps. You got to read the book, look at the PowerPoints, watch the PowerPoint video. You got to go through everything. Okay, you got to go through everything. So there's no shortcutting it. You have all these weeks. You really you have like 40 days, right, to still work on this course. Okay, so there could be 8 assignments. But you have the majority of it, but there could be more. There definitely could be more. But that's what that picture is basically. Oh, there it is. Look at that. Sorry. Yeah, sorry. I was hitting the up down. So yeah, there we go. Oh. Oh, yeah. Did I send you this? I have a feeling that I did not send this to you guys. Okay, so that's another thing. I got to send I got to remind myself. So like I said, so in tonight's email, I'll send you the 2 PowerPoints, 2 sets of PowerPoints, and the textbook. We'll send you all that and the latest. So there'll be one email that has everything as of now, and we'll take that whole group of people that are registered to make sure that people have all the documents just in one email. The rest is for Loan Income Corporation. Yeah, it's not the contractual, it's not the face, it's market. Okay, so yeah, again, folks, opportunity cost. If I went over opportunity cost with you guys, that would be weeks and weeks of discussion. So we're just going to talk about it very briefly. But that's a whole other discussion. Market interest rate or opportunity cost. That's a whole. You're on an island, and who's a specialist at something. It's all that type of thing. 10-year bond, maturity 200,000, bonds issued at premium. So bonds, which means it's issued above 200. So you're paying a lot for it. If you're paying a lot for it, the contractual interest rate is less than, or the market rate is bigger. It exceeds. It's going to be looking at that. So right, the contractual interest rate exceeds the market rate because you're paying more. Right, you're paying more for this. It's going to be A. Right. So if you're issued at a premium, which means you're paying a lot, so your interest rate is reduced, or your return is reduced because you're paying more to buy all those cash flows. So the contractual rate can exceed the market rate in that particular. Are they equal? There's no relationship. So it's going to be A for this particular one. And again, I can just quickly say these things because I've worked on this for a long time. But the more you do it, the more you're going to get comfortable with the bond interest rate, the rate of return, all that. Again, we're using candlestick here, and again for an instrument, face value, the time amount. The bond, the contractual bond rate at 100 means 100% of face value, and then the entry to record the sale. So looking at your journal entry is this. So some company, somebody running a pizza truck in Jersey City or a food truck or whatever it might be, they take $100,000 from a wealthy investor, and then their liability, which is a credit, they owe that investor $100,000. So this balances your equation where this is a plus debit, this is a plus credit because this is a liability, this is an asset. Okay, and again, just focus on that for a sec. Okay, but that's what that is. Okay, so and like I said, debit is left, credit is right, and then go back to that picture I sent you guys. That's in the textbook in chapter 2. Find the debit, credit, right, left, plus, minus. Find that little scale or that little memory aid, and you'll never go wrong. Like I said, there's no closed book anything. I want you to understand how things happen. Okay, I want you to understand how things happen. Candlestick, 100,000. Yeah, so the bond is issued on the 1st, and unless it's and generally they're not. The day you get the money, you don't all of a sudden owe an interest payment. But they're paid the interest is paid semi-annually in July and January. So most likely, if it's January 1st, the first interest payment will be July of 2012, and if it's an even number of periods, you're looking at finishing this thing up, July 10, January 10 years down the road, or 5 years down the road. So it'll be whatever, January 2017, because it's going to be 10 periods. It's 10 6-month periods. So the first interest payment. Now looking at this, you actually paid this, right? You incur an interest expense, right? That's an expense. It's a debit. It's a plus with a minus outside, and then the cash is credited. It comes out of cash, and it pays off the first interest expense. I might be saying, well, professor, this is 10%. How is it 5,000? Well, 10% times 100,000 is 10,000. But if it's paid semi-annually, you're paying part in July and part in January. So you divide it by 2. That's why it's 5,000, right? I'm sure that's a question you guys have it there. Also, looking at this journal entry records that you made a payment. No previous accruals, but if you just recognize the expense without paying it, this would be interest payable. And it would be the same position. It'd still be in the credit position, but the difference would be this is a plus, this is a minus, this is a plus, but it's all on the same side. The expense and liabilities are all on the right-hand side of the accounting equation. So they have to cancel each other out. These cancel each other out with the negatives, but this would be negative, this would be positive if it's a liability, if it's interest payable liability, and that it net out to be 0, which is that equation has to balance every time. Okay, so that's why that works. Semi-annual, previous no. So I just said this. So this is the next interest payment, in a sense, that this is the January 1st of 2013, but you recognize it on the 31st, and if you see here, it's simply a payable. It doesn't come out of cash. It doesn't come out of cash the next day, and then you write this over where you have a payable, you have cash, so the cash would be credited, the payable would be debited, and this would cancel out, and you'd pay off the interest expense. So interest expense means the expense is incurred. Interest payable means you owe it. Okay, expense means it happens. Payable means you're this is the amount of money that you're gonna owe. It's a subtle difference, but and again, this is all the finance world. It's all debt instruments. Okay, the debt markets are substantially bigger than the equity market. Now we're gonna start. Again, we're only up to slide 20, and we've been going a good half an hour or a little bit more. You have a $100,000 note, 5-year, 10% bond, payable semi-annual. Now, Candlestick agrees in 5 years to pay someone who lends the money $100,000 and then 10 interest payments that are going to be $5,000 each. That's what Candlestick agrees to pay. But someone's got to buy into that. So instead of paying $100,000 or $150,000, they're going to say, okay, I'll take your cash flows for 92. I'll give Candlestick 92,639, and then I'm going to pay you the 100,000 and then all the other. Now, if you do the math on that, you're going to pay 5,000 10 times, and then 100,000. You're paying 150, but you're getting 92,000. You're getting the 92,000 today, and you could build, expand your research and development, have a marketing campaign, build a bigger factory or something. You're doing some capital expenditure that's going to let you have a business that's supposed to throw up some money that you could pay this off and then some. That's the whole idea of lending. If we're going to lend this to you and we don't think you're going to succeed, that'd be a dumb thing to do. Now, the reason you see all these decimal places, you took this 92 over 100,000, and that's what it worked out in terms of a percentage. Now, when you take 92,639 divided by 100,000, it's 0.92639. But in percentage form, you move the decimal place over 2 places, and that's what that percentage means. It means with 2 more zeros type thing. You multiply by 100, and then you can write this as a percentage. Here's the issuance. Okay. So now, let's talk about the entry here, which is a little more complicated. Now, it's not just 100,000, 100,000. You broke up that 100,000. Again, this is from Candlestick's perspective. They took 92,639 from investors, and also they have to recognize that there's a discount, or that they gave a discount. So their debt to the investors in Candlestick are 100,000. They took 92, but then there's a $7,361 difference that they have to account for, and that's why there's an entry here. It balances out the face value that's owed in 5 years. You took 92,000, we owe that 7. Let's just say it's simply 93, and this is 7 type thing. Okay, then we'll have a premium, which will be more, right? It'll be on the other side, and so it'll be credit and all those other kinds of things. Okay, this is how it shows in the balance sheet. Okay, There's no life without balance sheets. Okay, you need to understand balance sheets, and you subtract out the discount, and there's a carrying value or book value on the balance sheet, and that's that $92,639. The sale of bonds will cause the total cost of borrowing to be more than the bond. Yeah, because what you have to do is, if you're selling instruments at a discount, you're taking less money than face value. You got to make up for the. You got to get up to 100,000. So this 7,361 increases your lending costs. Borrowers are required to pay the bond discount at the maturity date. Bond discount is considered to be increase in cost of borrowing. Right. So there you go. Right, increase in cost of sure. And again, we have all sorts of Excel examples that will illustrate this as we go along. And some of them look suspiciously like this. This is cost of borrowing at a discount. So here, what are you doing? You're borrowing 100,000, or you agree. Actually, even to say it even better, you agree to pay 100,000 in 5 years. You also agree to 10 $5,000 payments, like I just said in the previous slide. So you owe 100,000, you owe 50,000. Okay, you owe. So yeah, here's the 50,000 that's owed, and the 5,000 comes from 10% times a half times 100,000 is 5,000. 10 of those payments. And then you also got to make up the difference, right? So, I mean, total cost of borrowing, well, total, you have to put the 100,000 in there, all right? This is bonds issued at a discount, so it sort of left that out. I don't know why, but you have to add that 100,000 in there also. So that's the cost of borrowing, which means not including the principal, just the interest payments. And then if there's a difference, plus or minus, if it's at a premium, obviously you subtract the premium from your interest payments, because that means you got more money than the face value. You got more capital in the face value than what you're going to owe in 5 years. Here's the principal. Here's the payments. Add them up. Now, this is what you're paying to the person, the loaner. Or you're the lendee. The company, Candlestick is a lendee, and whatever. Let's say Bank of America. They're the ones that loan the money to Candlestick. So that's 100. So there's 150,000 that you got to pay them. They paid you 92. So so again, in business, folks, 10% borrowing. It sounds very sort of innocent, but it's not. I have a little bit of debt out there at a couple percent. It's just so it's certainly nothing like this. That's for sure. It's maybe 2 or 3% or something like that. And again, the better credit you have, the deal, the better deal that you get. I was involved with somebody a number of years ago who she didn't understand anything about loans and cars and that stuff, and just figured that it was just in America there's just free money, and I always think about her, and she didn't know how to manage all that well, and she defaulted on a sizable loan that she took out, and then didn't understand why when she went back for another loan that her credit or interest rate was like 35% or 25% on just a very simple loan that should have been a couple percent, but her credit rating was so bad that the bank felt that to lend to this person who already defaulted once, what are we going to do in terms of we got to charge this person a lot because we want to get as much of our money back as possible before she runs off, kind of a thing. So that was sort of the story of her life, unfortunately, for better or worse. Anyway, but yeah, so what you borrow, what your interest payments are, what you got from the bondholders, and then the difference is the cost. I like this. This is a nice one. Discount on the bonds payable is a contra account. We need to show you what that means, but a contra account means if it's a liability and it's a positive on the credit side, the contra account is on a negative on the debit side. All right, that's what a contra account means. Okay, is it to the discount of bonds payable has a credit balance? It does not. It has a debit balance. Increase, it does not increase over the term of the bonds. It does not. Is it? And I want to say, well, here's the answer. But I want to go through why everything else is not the answer also. C is added to the bonds payable. It's not added to the bond. It's subtracted from the bonds payable on the balance sheet. Okay. And again, I think you guys saw an example of that somewhere right there. See less. See what it says less. So it's subtracted, not added. Okay. And now we're at the premium part of this. And now again, get comfortable with premium and discount and 95% and 108%. And so you're buying at 108% of face value. So you're buying into these cash flows at 108,000. Okay, you agree to 10 interest payments. You agree to pay the $100,000 back. So you took 108,000 from a bondholder or a lender to you, and you're going to invest in your business and turn it into a profit-making machine, and you're going to pay them back, and then you're going to take the rest for you, type of thing. here's what premiums look like. I just mentioned this. This company took 108,000. They owe 100,000, but they also owe. I'm saying they owe 100,000, but they don't owe 108. They owe 100,000, so they took 108. But you got to balance out the premiums. You got to just list it here that we took 108,000. We only can pay back 100,000 type thing, but there's an extra 8,000 that we took because we have a hot idea. We have the vaccine for the virus. We have all these different things. We're Amazon. We're going to be selling a lot online and all this other stuff. Your household paper online is going to be sold through us and all these other kinds of things. And so you got to pay a premium to get into us because we're pretty certainly going to pay you back. That's sort of how that works and why someone would pay. Now, there's nothing. See, it's the mind says, okay, well, let's paying these bonds should be 100,000. But folks, there's all those other interest payments too that you have to include in this. Okay, so and like I said, I'm gonna go through the math in Excel how to do a valuation on mortgages and bonds. We'll go through it. But like I said, we're just introducing you to the ideas. So you go to bed at night and say, okay, let me think about bonds. Let me think about what he's talking about. And then we'll continue the discussion with models in Excel, which is where everything needs to be worked out. Now again, how you account for the premium. On the balance sheet it says my long-term liabilities 100,000, and then I just added the premium in there because that's what I took from the guys. From the lenders to me, but you're gonna write that off because you're not necessarily paying that 8,000 back. You're paying back all the interest payments. You're paying back the face value. We'll go through. Redeeming bonds. We'll go through that soon. Sale of bonds about face value because so close to be less. Yeah, because you took early on, you took more than 100 grand, and that helps you with the interest, and because it's such a great idea. And folks, let me tell you, any sort of worthwhile business venture, it all gets pitched to the Carlyles and the Bains and the whatever, the sort of the iron triangle of private equity firms. They get first shot at really making crazy returns. And you'll always hear somebody saying, "Oh, I wish in 1998, I wish I understood." Even big time private equity guys saying, "We missed Google, we missed that, we missed this, we missed that because we didn't understand it," type of a thing. So you'll see that kind of thing happen out in the world, where how else, and the firms fight to loan money to good ideas, believe it or not. Okay, I know that might be tough to picture that, but that does happen. So sales of bonds with face value because the total cost borrowing too less. Okay, fine. The borrower's not required to pay their own premium. Yeah, you're not required to pay it back. You're only required to pay the face value. That's why it's called a premium, and it reduces the cost of borrowing because they're giving you more to help pay off some of the interest payments. And here's the same kind of math where it's a $100,000 loan, 10% interest, half a year, 5,000, 10 payments, and then the premium is 8,000. Now the cost of that gets subtracted from this because the borrower took that 8,000. Okay, they took it. Okay, so they took the 100,000 and 8,000 more. So that reduced that. So for the $50,000 interest payments, it lightened the load, by almost a fifth. So who wouldn't want that? So $100,000 loan, $50,000 interest payments, $150. So the whole thing that's got to get paid back is $150. You took 108, and then you're netting out 41,000. That's the cost of. The cost of borrowing means past getting your 100,000. What are the costs to borrow that was 41. Okay. Here's the maturity thing. Actually, I'm not saying I lied, but it's not really 80. It's really like 65. Because there's the European accounting stuff is at the end, which we're not going to really go on. The company pays and records separately the interest for the last interest period, redemption of the bond. So yeah, let's show how the bond is redeemed. So the company pays off its liability. It pays that. So the idea is it ran a business for 5 years, piled money into its bank account, and then took out 100,000 and paid off its debt. That's all this says. So you wrote off your liability, you debited it, and then the cash was credited, which is negative. You can redeem bonds before maturity. You eliminate the carrying value at the date. So the date on your balance sheet, and we'll go through what that looks like, what the long-term liability is, what the current liability is. We'll go through all that again in Excel. And again, I'm just giving you the ideas. You've got to be able to put this together in the models. Recognize the gains or losses, record the cash that was paid, type thing. So you say, okay, we want to be out of debt, we'll pay you off early. the unamortized bond discount or plus the amortized bond premium and again, this is going to make a little bit more sense when we sit down to do the mathematics. It's a little hard to think, okay, the carrying value less the discount type thing or plus the unamortized bond premium at the redemption date. And let's do an example, and that'll be clearer as we go along. When they're redeemed before maturity, between the cash paid and the carrying value, okay, that's the gain. If you're plus or minus, obviously gain or loss. So again, what's on your books versus what's on your books is what you got and then what you paid to pay off, getting rid of that. And again, that's better served, through numerical examples, and we'll get to that. Yeah, so this includes the losses and all these other things. So let's take a quick look at this. It sold its bonds at a premium at the end of the 8th period. The council retires these bonds at 103. So what it does is it says, okay, we're going to retire early. We'll make a deal where we want to get this debt off our books. We'll pay you 3% more. We'll pay, instead of 100,000, we'll pay 103,000. So you're redeeming at a premium, type thing, retiring the bonds. And then it says, okay, so interest fine. So the carrying value at the time was, again, the money that the company was paid. So look at this. This is the company that took the loan. They took 100,000 and they took 1,623. They're only paying back the 100,000. So again, let's go through the numbers and just try to figure out what's happening here. So this 100,000 and then this extra 1,623. This is what's known as the carrying value type thing. You subtract that from the 103, and you get your loss. So looking at this, you paid the company paid off at 103. It only took in 101. So it's about a $2,000 or so, or $1,377 loss on the bond because the company paid out. Excuse me, the company paid out more than it took in. That's what and again, in Excel, that's going to make more sense. This is the common stock example. Until conversion, the bond is just a debt instrument. Excuse me. For the issuer, the bond sells at a higher price and pays at a lower rate of interest than comparable debt securities without the conversion option. Well, let's see, what does that say? Say that again. The bond sells at a height or a higher price and pays a lower rate than without the conversion option. Upon conversion, the company transfers the carrying value of the bonds paid to capital accounts. So again, and we'll go through how to convert to common stock, how to convert to paid in capital type thing, and we'll go through all of what that looks like. But here, I'm just looking at this. It says the bond sells at a higher price. Yeah, so looking at this, so what these guys are talking about is this is if it's selling at a higher price, it's a more desirable instrument because it converts into stock. Excuse me. Now I'm gonna get the hiccups with you guys. That was 4. So sorry about that. So there's a $100,000 bond sold at face value, and this converts into 2,000 shares of $10 par value at common stock. So looking at this, it's so this is a share in the company. And to make it simple, what these guys did was they said, okay, we're going to make this, we're going to make the market value. We're going to make the market value of the stock and the market value of the bonds the same, just for simplicity purposes. And we're going to say, okay, you're converting your loan into the company into 2,000 shares at $10 par. But here's the thing, though. Your 2,000 shares is only 20,000. You lent the company 100,000. So how do we deal with that? Right, we deal with it right there. And I taught this material. Pardon me, folks. I taught this material in this fall that we just had. So directly, the deal you made was the 20,000, and then the excess in terms of par value is another 80,000. So that's your 100,000 is what that is. Okay, so that's what that is. So again, the market value, it's a $100,000 loan, but the value of the shares is 130. That doesn't necessarily come into play on the balance sheet. Okay, so that'll be mark to market, which we don't use in this country because it can fluctuate a lot, and you'd have to have balance sheets that, maybe one day we'll have balance sheets that change every day type thing. But we don't have that right now. This is we're not technologically there yet to be able to do it. When bonds are converted to common stock, the carrying value is transferred to the paid in capital account. Yeah, I just showed you how to do that. Now, this is other notes and other things. Maybe secured by a mortgage that pledges title to specific assets as a security for a loan. Okay? So maybe secured by a mortgage that pledges title to specific assets as security for a loan. So typically terms require borrower to make installment payments over the term of the loan. Each payment consists of interest on the unpaid balance of the loan, a reduction in principal. So yeah, so this can be secured by a mortgage that pledges title to specific assets, security for the loan. Installment payments, interest on the unpaid balance, reduction in the principal. And again, we'll go through all of this. Now what happens with this is you're paying off the principal as you go, so you have like one final payment that takes care of all your interest and all your, and there's no big payment at the end like there is with bonds. That's the difference between long-term notes payable and a bond. And yeah, and again, folks, this is just a picture. Okay, there's nothing real about this. It's just simply a picture. We're going to go through interest periods, cash payments, interest expense, principal reduction, and obviously you want to, versus principal balance, you want to get this to zero. Right, you want to get all this stuff down here. Again, it's hard to show it on a PowerPoint, but that's what we're going to do. So it's a $500,000 loan, 12%, 20-year mortgage. Now, the book gives you the $33,000, but it doesn't show you sort of how to get it. I show you how the book computes that $33,231. And but again, in Excel, we'll go through how that all happens. Yeah. So this is just the first. When the company gets the cash, it acknowledges a mortgage payable. So if the company says, what important technology, it owes $500,000. It took $500,000 in cash, and now it's first interest expense. And again, we're going to go through how all this happens in Excel. Debit expense $30,000, write off some of the payable. Those numbers combined is that $33,000. But again, we're going to go through how to do all that. I don't expect you just that I went through it in 10 seconds here that you understand all this. Okay, but we're going to go through how to do all that. Each payment on note payable consists of interest on the unpaid balance of the loan and the reduction. It's not just interest on the original balance of the loan. It's not just the reduction of the principal only. Interest on the original balance of the loan. So yeah, it's interest as the loan goes along, and then the reduction of the principal. This one could be deceptive. It's on the unpaid balance, not on the original balance. Which means that as you pay off the loan, you're paying more principal and less interest deeper into your years. Okay, you pay a lot of interest up front and then less as you go along. This is an article going back, and again, this book was written about 10 years ago, so I apologize if that's if that strikes anybody as odd, but the book is fine. Okay, there's nothing. The accounting hasn't changed that much in 10 years. This is right after the financial crisis, which I sort of like using it for that reason. They have a choice in the form of long-term borrowing that they undertake, issue bonds or notes. Notes are issued from a single lender through a bank, and bonds or the company divides the borrowing into, I mentioned this before, into many small investing units, and enabling one investor to participate in more than one investor to participate in the borrowing. The private equity firms, either they lend or just make investments type thing, equity investments. The graph shows the companies that's recently now borrowing more from bond investors than from banks. So yeah, so at this particular time, again, this is 09. I don't have this graph right now, but just look at this. Corporate bonds versus corporate loans. Loans were the darling of lending up until the financial crisis, but then the bond world didn't change too much, but people did pile into it a little bit more because they felt it was safer. But certainly when there's a recession, loans drop off at the end of a cliff. So again, I can interpret that with my financial analysis eye as to what happened here and why. There was a flight to capital, a flight to safety in bonds, and then Main Street businesses borrowed less because there was a recession, almost a near depression type thing. And then there's a discussion about interest rates. Interest rates were low, and all that. So there's more bonds and what have you. How inflows into fixed income funds triggered a bond issue as banks cut back lending. High rated companies riskier to borrow from a bank than in the bond market. Yeah, so it says the reason high-rated companies were tended to rely on short-term to fund the capital but were left stranded when these markets froze up. So yeah, so looking at this now, sometimes this is longer-term bonds instead. You know, again, where are you getting your financing from? The bond market, the mortgage market, or whatever? Again, anything. It's the basic instrument, and people just use it as collateral. They use the cash flows as collateral. They use properties as collateral because an instrument is considered an asset. Okay, and if it's got cash flows, you know, you can use it as collateral. But you can get into a lot of trouble because it's very complicated, and if you don't know what you're doing, you know, obviously there's big problems if you don't know what you're doing, which I've witnessed, you know, often. And so anyway, yeah, and again, this was, if you guys want to take a break for a second, let me see. Yeah, this is long. This is long, so that might be. Yeah, we're up to 71. The leases is that's if we want to do this in maybe two parts, which I think might be a good idea. The leases might be a good place to maybe just put a fork in it for the night, and I'll do the other half of this tomorrow. Okay, so let's maybe look at it like that. Because like I said, I want you guys. I don't want to just drone on through all this stuff, and then you know. But this is usually one chapter. What I just did right now, that's so we have a whole other set of things. So we'll pick up with leases tomorrow. Okay, so maybe we'll just do it like that. Okay, and then, like I said, the second half of the conversation, the stuff is a little more complicated, so I don't want to get too hung up on that. Yeah, I hope you saw me the whole thing. I hope you guys saw me the whole way. So anyway, folks, but yeah, this was a long initial discussion here. We'll have the second half of the PowerPoints tomorrow. But like I said, Excel, we're working in Excel in the not too distant future. But like I said, I don't want to make it too unwieldy where if it's so long and it's hours and hours. Now I'm trying to keep my videos for hour and a half, you know, that type of thing. I don't want to just go on and on. But like I said, we'll pick up the rest of that tomorrow. Okay, folks. Like I said, I hope the first class was a good experience for you guys, and we're just gonna keep going. So just expect a bunch of these videos for the next couple of days. You'll work on the assignments, and it'll be June before you know it. Okay. All right, folks. Be well.